Before you invest another dollar in crypto, you need to hear this. The biggest mistake new crypto investors make isn't picking the wrong coin, it's investing money they can't afford to lose, and then needing it back at the worst possible time. AI has a specific framework for building a crypto safety net. Here it is. Financial security and crypto investing are not opposites, but you need to build them in the right order. Let me show you the AI recommended sequence. Step 1. Traditional emergency fund first. Before we even think about allocating a single dollar to the crypto market, we need to build a solid foundation. Across every AI model we consulted, from the most conservative to the most risk-tolerant, the first and most critical step was unanimous. Establish a traditional emergency fund. Think of this as your financial shield. It's the bedrock of personal finance that protects you from life's inevitable surprises. A sudden job loss, an unexpected medical bill, or an urgent home repair. Without this buffer, any financial shock could force you to sell your investments, including crypto, at the worst possible time, potentially locking in huge losses. The core principle is to separate your survival money from your investment money. The universal recommendation is to save 3 to 6 months of essential living expenses. Now, what does that include? We're talking about the absolute necessities. Your rent or mortgage, utilities, groceries, transportation costs, insurance premiums, and minimum debt payments. It's not your eating out and entertainment budget. It's the bare minimum you need to keep your life running without adding financial stress. Where should you keep this fund? The key here is liquidity and safety, not high returns. The ideal place is a high-yield savings account, or HISA. These are FDIC insured, meaning your money is protected up to $250,000. They are completely separate from the stock or crypto markets and offer significantly better interest rates than a standard checking account, helping your fund at least partially keep pace with inflation. A money market fund is another excellent low-risk alternative. Let's make this concrete. If your essential monthly expenses are $3,500, a fully funded 6-month emergency fund would be $21,000. This is your non-negotiable safety net. If you don't have this, any money you put into a volatile asset like cryptocurrency isn't truly investing, it's speculating with your rent money. AI models consistently flag this behavior as a high-risk, net negative financial decision for the vast majority of people. Building this fund first isn't just a suggestion, it's the prerequisite for investing responsibly and sleeping well at night, no matter what the markets are doing. Step 2. The crypto safety position. Now that we've established the critical foundation of a traditional emergency fund, completely separate from your investments, it's time to build the next layer of your financial fortress, this time within the crypto ecosystem itself. This is what our AI framework calls the crypto safety position. It's your strategic reserve, your digital dry powder, ready for deployment when opportunity strikes. The core recommendation is to allocate between 10% and 20% of your total crypto portfolio value to stablecoins. For this purpose, we'll focus on the two most established and liquid options, USDC, which stands for USD coin, and USDT, also known as Tether. So, what exactly are these digital assets? Think of them as cryptocurrency tokens that are pegged or fixed at a 1-to-1 value with the US dollar. 1 USDC is designed to always be worth $1. 1 USDT is also designed to always be worth $1. Unlike Bitcoin or Ethereum, their purpose isn't to increase in value. They are engineered for stability. They don't go up or down in price, they just sit there, holding their value, mirroring the dollar in your bank account but living on the blockchain. This stability is achieved because for every stablecoin issued, the company behind it holds a corresponding dollar or a highly liquid, equivalent asset in reserve. These reserves are regularly audited to ensure the peg remains secure, providing a reliable store of value amidst the volatility of the broader crypto market. This begs the question, if they just act like dollars, why not just keep that money in your bank? The answer comes down to one critical factor in volatile markets: speed. Let's walk through a small scenario. Imagine the crypto market experiences a sudden, sharp correction. Bitcoin drops 30% in a matter of hours on a Saturday afternoon. This is not a time for panic. For the prepared investor, it's a significant buying opportunity. If your capital is sitting in a traditional bank account, you first need to initiate an ACH transfer or a wire. This can take anywhere from several hours to multiple business days. By the time your funds arrive on the exchange, the market may have already recovered, and the discount you wanted to capitalize on is gone. Now contrast that with having a crypto safety position. With your 10-20% allocation already sitting as USDC or USDT directly on an exchange or in a wallet you control, your response can be instantaneous. You see the dip, you log in, and within seconds, you can redeploy that stablecoin position to buy more Bitcoin, Ethereum, or any other asset at that heavily discounted price. You don't need to wait for banks to open or for transfers to clear. You are in complete control, able to act with precision at the most opportune moment. This speed is not just a convenience, it is a profound strategic advantage. It transforms a moment of market fear into a calculated opportunity for you to strengthen your long-term positions, effectively lowering your average cost basis. This is the primary function of your crypto safety position, to ensure you are always liquid and ready to act, turning volatility from a source of anxiety into a tool for growth. Step 3. Earn on your safety position. Now we arrive at the truly transformative part of this strategy. Your stablecoin safety position, that 10-20% of your portfolio we've carefully set aside, doesn't have to sit idle like cash under a mattress. In the world of digital assets, even your safety net can be put to work, generating a passive income stream while it stands guard. This is where you turn a defensive asset into a productive one. So, how is this possible? The answer is, through yield-earning platforms. Think of them as high-tech savings accounts for your crypto. Centralized platforms such as Nexo have built entire businesses around this concept. When you deposit your USDC, they lend it out to other verified institutions or individuals who need to borrow stablecoins, and in return, they pay you a share of the interest they earn. It's a familiar banking model, just upgraded for the digital age. These platforms typically offer an annual percentage yield, or APY, that can range from 8% to as high as 12% on stablecoins. Let's put that into perspective. You're earning more on your crypto safety net than most people earn on their regular savings account. While a traditional bank might offer you less than 0.5% in interest, your stablecoin position could be generating 20 times that amount. This isn't just a small bonus. It's a significant financial engine that actively grows your reserve fund over time, without you having to do anything. The power of this lies in compounding. Let's say you have a $10,000 safety position earning 10% APY. After 1 year, you'd have $11,000. The next year, you earn 10% on that new, larger amount. Over several years, this effect accelerates, substantially increasing the size of your buffer. This passive growth means your safety net is not only protecting you from market volatility, but is also becoming stronger and more robust with each passing day. It's a proactive defense. Now, it's crucial to address the risks. Entrusting your assets to a third-party platform requires due diligence. You should always research the platform's security measures, insurance policies for assets, and their business history. While the yields are attractive, the safety of your principal is paramount. As always, this information is for educational purposes only and does not constitute financial advice. So, to recap the AI framework in action, you have 80% of your portfolio in active crypto positions, poised for growth. The remaining 20% is your stablecoin safety reserve, held in a yield-bearing account, earning substantial interest while it waits, ready to be deployed. This isn't just about surviving the dips, it's about thriving through them. Nexo setup guide and Coinbase stablecoin link are in the description. This is genuinely one of the most important structural decisions in your crypto strategy. Subscribe, and tell me, do you currently hold any stablecoins in your portfolio?